I've been so impressed with the capability of insurance and reinsurance to manage basically their portfolio of risk. There's so many creative structures out there to basically push risk into different markets, right? You talk about a new technology, the feedback we hear is, oh yeah, we think that's important, but we haven't quite figured out how to approach it yet. But the ability to innovate as quickly as the market is demanding is maybe not the strength of a giant corporation, but really, really good at managing the risk on the back end. The challenge of MGAs generally is how to bridge that gap, bringing innovation while still managing the traditional risks and the traditional portfolio management and the language of a traditional carrier. That's part of the art of us as a company, is bridging the language and those knowledge gaps. Hi, I'm Jason Kaminsky, the CEO of kWh Analytics, and this is the future of insurance.
This episode is brought to you by Pinpoint Predictive, who provides P&C Insurance unmatched risk selection at the beginning of the customer journey. Pinpoint has revealed hundreds of millions of dollars in value for top 10 insurers by quantifying unpriceable risk like loss cost and litigation and fraud propensity earlier and more accurately. Pinpoint provides the largest and fastest improvements to loss ratios, less than 30 days to develop immediate deployable custom risk scores. To learn how a growing number of insurers are partnering with Pinpoint to improve their loss ratios, visit pinpoint.ai. Jason, thank you for taking some time and sitting down for a discussion about what you guys are building.
Absolutely, Brian. Happy to be here.
So, first of all, who are you? Who are you? What are you doing here? Give us a little bit of background on you.
It's a great question. So, I'm Jason. I'm the CEO of kWh Analytics. So we're I was going to say a Bay Area company, although since the pandemic, we've become a national company.
Just a really big Bay.
The Bay's expanded to the East Coast, exactly. And we are in the space of climate insurance. I'll just start with myself briefly. I actually come out of the renewable energy sector. So out of business school, this is now 13, 14 years ago, I started as a solar developer. So the folks that would go sell and build projects, solar projects in particular. And then I moved into the financing space. So I was at Wells Fargo financing renewable energy projects. And then about 8 years ago, joined kWh. At the time, we were a data company, and I can tell you a little bit more about the company. And we moved into insurance about 2016 era. So since that time, 5-6 years ago, I've been really focused on specialty insurance products that can help support the growth of our space, the renewable energy segment.
So when people hear you say the name of the company and you say analytics, they're probably not expecting that you're actually looking at taking risk. Maybe more facilitating those who do. So tell us about the company.
Yeah, well, it's a good point. So when the company was founded, it was it was myself and with the background I just had, and a friend who was at McKinsey, and one of the early investors is a gentleman named Van Skilling, who ran various data companies in his career. He ran Experian and ran CoreLogic, and the early guidance was go collect a bunch of data. Solar at the time was kind of a nit of an industry, and you'll figure out what to do with it. And both of those firms, they sell it back to the financial community. But collecting data in an emerging technology space is not the easiest effort in the world. So the first 4 or 5 years is all about creating a data ecosystem. Mm-hmm. We sold software to the banks that were investing in solar projects and helping manage their portfolios, and then using the data flowing through our platform. And we created a data co-op model with asset owners where they contribute data into our data set. We're able to analyze it, put out industry research, share benchmarking back with them. But it's really enabled us to have a very unique view of the risk. So when I say data, I mean things like where are solar projects and renewable energy projects, where are they located, what technology is deployed, how are they performing, what's happening on site, how do people think they were going to perform, which is important because they're often different. In 2015, we collaborated with the Department of Energy to put some data science heft behind the data and say, what can we learn? And what we learned is, hey, we actually have a better view of how all this equipment performs than really anyone else in the space. There's third-party models that people use in the solar space to basically forecast solar production. Yeah. And they're based off physics models, and they haven't, because the data is very hard to access, they haven't been validated by real-world data until the award we did with the Department of Energy. So that allowed us to have a more accurate view, and B, a more probabilistic or stochastic view about technology that really enabled us to then enter the insurance space. And I can talk about that
I want to get into it, but it's interesting. It's like your old role, like at Wells Fargo, was that sort of the customer for the original product? or one of the potential
Exactly.
customers.
Yeah.
Yeah.
At Wells Fargo, I'll say most of these banks, you invest into projects. So let me just touch on project finance because it's probably not super intimate to most of the folks listening. But the life cycle of a technology is you have some technology innovation, you maybe get some venture capital to back it. And the holy grail is what you call project finance, which is dedicated capital to a project where you can ring fence the project. So anything associated with that project, now the lender or the investor is taking that risk. And that's great because the corporate entity is not taking that risk. Yeah. So you could think of a solar project, you build it, that project now needs to stand on its own legs. So the revenue that it generates goes to pay off the loan. The expenses come out of the project's own pro forma P&L. If the project goes bankrupt, the ultimate owner is not responsible for it. Yep. So project finance drives pretty much most of infrastructure, but solar, wind, other renewables really began to access that, I'll say the early 2000s.
Okay.
And that's what I was doing at Wells Fargo with a twist, which was there's tax benefits available for renewable energy assets. So I was doing tax motivated project finance, but at the end of the day, it's the same thing. It's what's the portfolio of risks? Yeah. And then how do you allocate them to the parties that understand them the best? And insurance was historically not a big element of that, but it's becoming more important.
Well, the products were just sort of like traditional insurance products, which could have been any project. I mean, maybe they understood less about the construction work or the property it was on or something like that, but insurance hadn't really come into the space yet. But what's interesting is you go from this data solution. How do you then transition into saying maybe there's a risk transfer story in this as well? They don't know too many tech companies that are like, you know what we should do? We should get into insurance somehow. So how do you make that?
That's a great point.
Obviously, everyone listening is like, well, of course you do. That's a brilliant thing. You want to get into risk transfer, but how does that occur to you and why?
Yeah, and insurance is really hard if you're not an insurance person by trade. Yeah. So I realized I didn't really answer your first question. So anyway, as a bank, you invest in a lot of solar projects or technology projects, and the systems and platforms were non-existent to manage the data. So you're right. So that was the software that we built. When you look at project finance for new technology, it's great that it exists, but it's not always optimally designed. So if you look at auto fleets or you look at aircraft, you look at anything else, typically they can raise 90% plus of the capital from debt.
Wow.
Right? They're like pretty stable assets. The life and performance of these assets are pretty well known. It's all sorts of things that are raised in project finance.
Yeah.
When you look at renewables, it's closer to 70% than not 90%. And the reason for that is that it's a newer technology and there's volatility. And a bank, like the worst thing that can happen in a bank is a default. Like it's pretty common for an insurance company to pay a claim, but if you have a default, the bank like sirens go off. There's specialty workout groups that come in. You don't really want that in a bank. So the bankers appropriately, maybe you could say, designed their loans to be pretty conservative. And that was kind of the insight that we had is, hey, if we know production the best, and most of these projects have a long-term offtake, so the source of volatility is really coming from production. They have a long-term purchaser of the electrons. If we could put a floor on that production, you can functionally put a floor on the revenue and de-risk the investment for the lenders. And even if they knew this info, they probably would still be structuring it pretty conservatively, just because they're like, well, we can only take a 1 in 100 or 5 in 100 chance that this is a default. So we're able to move that risk into the insurance markets, which I would say is just a better form of capital for the kind of risk, right? They can take some of that tail risk in a way that a bank really can't. And the lenders are able to give preferential terms to our clients when this product's in place. So we call it the solar revenue put, but it's a long-term floor on production structured as insurance. You could think of it as we sell it to our clients as a credit enhancement, but basically we're taking a component of the risk, we're transferring out of the project finance structure into a different capital stack that unlocks value. And they get terms that are better for them and ultimately help enable projects being built.
Who's the customer then? Who ends up taking out the policy? Is it the folks who are building the project, or is it the banking or the the financing side?
Yeah, it's a good question. Ultimately, the beneficiary is this project entity, as we call it, a special purpose vehicle. So you could think of it as the asset owner.
Okay.
But obviously, the lenders need to understand how the project works. So that was one of the, I'd say, honestly, a challenge as we were coming to market is you have to educate two different halves of the market.
Yeah.
In order for it to work, you need both the bankers to understand it, and you need the asset owners to understand it.
It's almost like you need to get the insured and any potential claimant to agree to and understand the policy ahead of time, like in personal auto or something. I mean, not the same, but yeah, there's two sides to it. That is really complicated.
Well, and as we touched on, most bankers didn't deal with insurance all that heavily. So when we first showed up, we'd always hear, "Oh, well, I crashed my car and I had a hard time getting a claim." Like, how are you going to pay your claims?
Yeah, this has nothing to do with that.
Yeah, exactly. So now that we have a claims history and we've paid all of our claims in less than 30 days, that certainly has helped garner comfort. We're now more than half of the banks that are active in the renewable energy space have actually utilized the project in one of their financings.
It reminds me of you said trade credit or like transaction liability kind of coverage or contingency coverage more so than, people bring up their auto policy. And yes, I also just did that. It really has nothing to do with that. It's a completely different piece of, it's still P&C, but very much specialty lines.
Yeah, no, I just say that to there's outside of insurance podcasts and the insurance environment, even within finance, there's very little real understanding of how the entire insurance business works. So everything kind of just gets lumped together to the one emotional experience they had 10 years ago.
Right.
Even if it's totally different, and we all know that.
Right.
To someone who's, dealing with insurance as an expense that they just have to deal with every month or every year.
Right.
It all kind of gets lumped together as insurance.
Did you have claims?
We have had claims. So which honestly, our first claim, we were actually pretty happy because we're like, hey, look, now we can answer this question, settle the claim very quickly. Yeah, and prove that it's adding value into the transaction. So we were actually oddly kind of happy when we had our first claim.
Yeah, no, that happens, and that's a normal young insurance or new line of business thing. Is obviously you don't want to. You wish you didn't have the outflow of cash, but to prove the point, to show that there genuinely is a need, to have that story and to test in production, the whole concept worked.
Exactly.
That's okay. It's not as bad as people who work in the capacity side or the reinsurance side looking at storms and also getting excited when there's a big hurricane coming because it means they're going to take capacity out of the market and we'll get some hardening. It's let's just understand why. People are going to have their lives upended.
Fortunately not that. So the revenue put we made complementary to property products. So you could think of it as a non-damage business interruption, but we're paying for shortfalls in revenue due to effects that are not property related losses. Yeah. So the one thing that the finance community knows about insurance is we don't underwrite nat cat risks, and honestly, banks aren't good at that. Don't understand anything about nat cat risk. At least not the project finance groups that are in the renewable energy market. So we don't underwrite that, but people buy insurance for it. So people feel comfortable generally with that, at least historically. So we kind of took more dedicated, I'll call it specialized risk within the project finance structure. And it's kind of in a space that is emerging that we're calling climate insurance, which is insurance that can help enable the emergence of new technologies. And there's a couple firms in this space, like New Energy Risk for a long time was helping underwrite really emerging technologies. I think they're pretty involved with Bloom in the early days, fuel cells. There's a firm called Energetic that is helping underwrite and wrap kind of small, medium-sized businesses. So helping with the credit risk element of project finance and enable customers that might not otherwise be credit worthy,
right?
Unlock the benefits of renewables. So I could probably count them on one hand. The space is not large, but I'd say it's emerging, and there's very specialized risks that people need to understand in order to succeed in this space.
It's really interesting to me, and for those of us in insurance, when we hear about how insurance is helping to spark new ideas, economic development or expansion, that's really, I think that's a really positive story for us, rather than, the frustration stories people might have had with that homeowners or auto claim years ago, or just thinking it's just that thing you have to get that you didn't want to. I like to remember not just standing by people, but the fact that we enable the entire economy globally, including expansion and new kind of ideas or solutions to major global issues like the
Right.
climate crisis, which affects all of us, not just as humans, but insurers. I mean, whether you write climate exposed risk or not, it's taking up capacity. It's affecting reinsurance rates on even on other lines because there's less capital available. But is this put the sort of derivative solution? Is that the main product, or are you looking to take what you understand about the space and look to other lines of business, or bring your depth and difference of knowledge to other solutions that the renewable space might need?
Yeah, well, I'm going to pick up on your thread of it enabling technology, because in 2000, probably 2 years ago, so what is that now, 2020, maybe late 2019, a few of my former banking colleagues just throughout the industry were asking us about property insurance, which, I used to just say buy as much as you possibly can, and the client would come back with as much as I needed, and it was kind of a check the box. And I got on a call with about a dozen lenders, and the themes were, A, we don't really understand insurance, but B, our clients are now saying they can't procure what we expect, and most of them are in technical default with their loan contracts, which is never a good spot to be. So we're signing waivers. And it's inhibiting the ability for us to do deals, because it's moved from the bottom, check the box, up to now like a top 3 risk.
Yeah.
And if you have a deal in Texas that can't get insurance, we're not going to finance it, and you're not going to build it, basically.
Yeah.
So it moved from a check the box way up the priority stack to the point where it could actually inhibit deals. And at the time, we were not active in property insurance, but we took our same data-driven model. We added a whole lot of historic loss data into our database. So we actually have about 50 billion worth of assets where we know the loss history, we know the events that occurred, we know which ones led to losses and which ones didn't, and are using that to enter the property space. Because what happened in renewables, the broker in our market, Sarah, who I have to attribute this to, but she calls it a correcting market embedded in a hardening market. So, so we all know that the property market in general has hardened. I mean, all of insurance has kind of hardened over the few years. But there was a seminal event that, if anyone knows anything about renewable energy insurance, was a big hailstorm in 2019 that led to about an $80 million loss in Texas. And the theme is generally the market was pricing to grow and pricing to historic losses, and the risk profile of the underlying asset was changing. And honestly, the nature of cat events were changing, and it kind of caught the industry blind, kind of caught us by surprise. And, it was followed the next year by some localized fires on site. So there've been pretty material, I'll call them extreme event type losses, that have really forced our market to correct while the entire market's hardening. So we saw rates increase. We saw the guy who runs my property division, he calls it the Nat Cat fundamentals, but percent of TIV deductibles and sublimits for cat and things that probably should have been in our market previously. But it's really added stress into the project finance landscape, because project finance lenders don't understand insurance. I would say insurance doesn't really understand project finance for the most part. We bridge that gap because we come out of both worlds. But now you're in a situation where the bank hasn't underwritten Nat Cat. They don't know what AIR or RMS is. They've never heard of a PML until last year. These are not concepts that they deal with on a regular basis. But they're saying, you're telling me if there's a hailstorm, the project has to take the first $10 million of loss because your deductible is big. So let's use our project finance tools to solve that. So we put in a big reserve, or we push that risk to the asset owner, or they do something to kind of push around that risk. But it's really been a challenge, I'd say, for our space within this kind of climate insurance space. Because generally the data historically has been poor. The models are not very well tuned for this asset class. And people have lost money. So, we're taking a different lens on it to say, okay, we know the data, we can calibrate the models, we can use our market knowledge and our data to, I kind of call it the hard data, which is like we physically go in and we change the models or tune the occupancy codes to match what we see happening in the field. And then the soft data to say, okay, we go to solar asset management conferences, we know this OEM fails at low wind speeds, we know these clips are bad, and we can kind of know how to snip off the tail. Because ultimately, if you can avoid the worst pool of projects, that's driving all of the losses in our segment, and outperform the market. And I'd say even go one step further than that, which is give feedback to our clients or the people submitting applications about what they can do to make their projects more resilient. I'd say if in all of this, that's one positive element, is because insurance isn't just writing off the risk. The risk has been pushed back to the owner, and a lot of innovation has happened to make projects more resilient. Yeah. Like if they're holding the bag for the first loss, they're going to get creative about ways to avoid that loss. And that's kind of that data co-op model that we play. So we can give them feedback and say, hey, we've heard this other party over here has a hail mitigation program, and here's how it looks, and have you guys considered that? And you should hear some details about it. Because in our space, like no one wins if, it's a very competitive market, but no one wins if their competitor's system gets destroyed by a hailstorm.
Right.
No one wants that to happen.
Yeah.
So we're able to anonymize but share some of that information back to ultimately harden the physical infrastructure in the ground so that you don't have those types of losses.
Yeah.
I covered a lot there. Apologies.
No, but
maybe a long answer, but
it seems like actually both of the products, the property, like traditional property cover that you're talking about, but also the original solar revenue put, that both of those benefit from that kind of breadth of knowledge you have in seeing across so many projects and things. Because we talk about being more proactive on risk and try to stop the claims before they happen, which obviously in a CAT, you can't stop the storm from coming, but you can make the project more resilient to it. But if you're talking about the financial performance of the asset, are there things you can insert into the relationship so that they make better choices in the deployment and the management of it, and seeing across such a wide pool of projects, I was going to say platforms, but projects, allows you to give that same sort of, I imagine, that same sort of kind of preventative guidance, the analog of like drive safer or avoid this area because there's ice on the road and that sort of thing. Are you able to apply that in either case to try to help the assets perform better regardless?
Yeah, it's you're right. You can't stop the hurricane from coming, but you can do site prep, right? In the case of a fire, you can mow, call it vegetation management in our space. It's still a pretty young segment. So it's even, okay, there was an event that occurred. How do you define damage? That's still, how do you define loss, I guess? It's still a moving target in our space, right? So, okay, so there was heat on the back of the module. Did the module break? Do you have to replace it? So we know all the testing labs and all the experts that help adjust that and have our own view on what makes it actual physical damage to a piece of equipment. And then supply chain issues are pervasive everywhere. So how do you have your network to then resolve that claim quickly? So all of that are things that we think give you an outsized edge in the market. And, I like to think about my former banking days in the sense that if I take Wells Fargo, right, the group I was in was called environmental finance. We had an energy group. They were doing oil and gas. We had a power group. We had a utilities group. We predates me a little bit, but we looked at renewables and we said, it seems easy. Everyone likes to say you snap Legos together and it's done.
Yeah.
But there's very specialized knowledge that's required in this space to perform well.
Yeah.
And that's how the environmental finance group was formed, was let's bring in people that know the asset class. And they hired me out of a developer, right? I wasn't doing finance before. And it requires specialty knowledge. And when I look at insurance, I'm seeing some of the same themes, right? You have power groups, you have oil and gas groups, you have energy groups that are looking at renewables, maybe dabbling, which is, I mean, hey, I'm glad people are doing it. The space needs as much insurance as we can get. But when I look at kind of all the specialty risks, how quickly the technology is changing, how powerful the data can be, I really think, coming from the space and knowing the language and knowing the players and being able to navigate really gives you an outsized edge. And honestly, banking figured that out a decade ago. I think insurance will get there, but that's really the lens on the market that we've taken.
Well, so instead of looking a decade ago, I want to look a decade ahead. And I always ask people kind of where things are heading. And for you, I think there's two aspects of this, because it's not just about kind of where you see the insurance side going, but the core space that your insurance is focused on is still extremely young. I mean, maybe it's not super nascent, not like you're early days in it, but it is still really young. There's still lots of legacy energy tech out there, but things are starting to change, and it's more of the conversation. But where do you see, I mean, sort of for those two moving together, where do you see things heading?
Yeah, I mean, in the US today, I pulled up the EIA, the Energy Information Administration. I was looking at their forecast yesterday as I was preparing for this. Their forecast for this year is that half of all new power built will be solar, and 3/4 of it will be solar, wind, and storage. Wow. So the only thing you can build, the remaining of it's mostly gas, but the only thing you can build today is renewables, right? Both because there's a social license for it, and also it's just the cheapest form of electricity that you can build these days. So if I look at a decade, right? I mean, to meet, setting aside even our climate goals, but to meet our climate goals, we kind of have to continue to double and probably triple and quadruple every year. There's a lot more of this physical infrastructure that's going in the ground.
Yeah.
And I would say the demand for insurance today kind of outstrips supply. A lot of the insurance is going to London, kind of specialty groups. There's not a ton of dedicated expertise on it. If I look at kind of the other end, which is more ESG broadly, and I put on a little bit more of my maybe like climate activist hat, not that I am a strong climate activist, protesting in my day job, but when you look at kind of the historical nature of that, I think energy companies were targeted first, right? Like, hey, stop drilling, let's go protest Keystone XL, which is still happening, but that was really the lens. It moved into banking. When I was at Wells Fargo, I worked in the headquarters building, and we were shut down by Greenpeace because Wells Fargo was financing Keystone XL, and the activist network was not supportive of that.
Sure.
And then I think they figured out, hey, insurance gets renewed every year, right? If you make a loan to Keystone XL, it's a 20-year loan or 30-year loan. Make that decision once. Insurance, you got to redo every year. So, hey, let's go pinpoint that segment.
Yeah.
And now at, major sporting events, you'll see blowups targeting insurance companies, blow up air balloons, basically saying, stop insuring coal, stop insuring oil. Lloyd's was shut down. We're recording this in April. Lloyd's was shut down last week, I think, by Extinction Rebellion. So, the social pressure, I think, to be attentive of the issue and maybe redeploy capital is happening at the same time, right? So those injunctions, right? There's kind of the social license to operate, and then there's the demand. And I think they both are saying ESG, climate motivated investments are needed. And I'd say maybe the third pillar of that stool is we don't figure it out, cat losses are only going to get worse, and the entire property business becomes very challenging to operate in.
Right.
So there's kind of like three maybe pillars to this stool. Maybe I'll think of a fourth one as we're talking. But that, to me, all point towards the need to get really smart about this space really fast, probably across the whole industry.
Yeah. Yeah. I mean, it is really, it's fascinating when you think about how much of the problem on the climate side drives the problem on the loss side. And some carriers definitely get it, and some get it and want to take action, and some get it and say, yeah, but the economy hasn't moved enough yet, so there's still too much money to be made, and we have to, and we owe that, if we're public, we owe it to our shareholders. If we're a mutual, we owe it to our, whatever their story is, kind of having a fiduciary duty to get the best return for the capital that they can. And I get that. But the flip side is, like you said, there's basically no investment in new energy projects that aren't for new energy. new energy sources. So at some point, those assets will not be valuable. That space is on the decline and certainly will be 5-10 years out. So it kind of boils down to, so when do you flip that switch? Because you're going to have to eventually anyway. But the longer you delay, the more it's costing you on the loss side or the cost of reinsurance or whatever. I mean, it is, people sort of seem to like cordon it off and like, well, look at the premium. There's still great money. It's like, well, but there's all these other things that cost you far more than what that premium's worth. And are you looking at the whole picture?
One thing, so I look at things with a finance lens, and I'm still reasonably new to insurance. But, when you're an M.B.A. raising capacity, I've been so impressed with the capability of insurance and reinsurance to manage basically their portfolio of risk, right? All these stacks of reinsurance, and there's so many creative structures out there to basically push risk into different markets, right? And discussion of hotspots and EP curves and PMLs and all the stuff that we don't think about in finance, at least not historically in the spaces I worked. So really, really good at that. And then you talk about a new technology, and the feedback we hear is, oh yeah, we think that's important, but we haven't quite figured out how to approach it yet.
Yeah.
So, maybe I'll call it innovation. I don't know if that's the right word, but the ability to innovate as quickly as the market is demanding is maybe not the strength of a giant corporation, but really, really good at managing the risk on the back end. So that's been part of maybe the challenge of MGAs generally is how to bridge that gap of bringing innovation while still managing the traditional risks and the traditional portfolio management and the language of a traditional carrier and reinsurance carrier to bridge that language, frankly, of here's what's happening in the field and here's the technology deployments. And I employ a lot of engineers that have PhDs and everything from like module design to space physics to, you name it. But I mean, that's good, but they don't speak the language of EP curves. That's where my CAT experts come in. And that's part of the art of us as a company is bridging the language and those knowledge gaps.
There's a lot of bridges to build.
A lot of bridges to build.
Yeah.
That's entrepreneurship, I think.
It is, yeah. And I think your point in the MGAs is actually like, it's kind of brilliant if you stop and think like, what if we had this traditional capital base that does do a good job at managing the portfolio and maybe struggles on the product innovation and the responsiveness side? Well, maybe that's where the MGAs can come in really effectively. And I mean, to the point of what you're building is, it's like the aircraft carrier. It's really hard to turn an aircraft carrier, but that's why it launches planes and helicopters and whatever. Maybe you guys are the planes and the helicopters. But in a non-war environment, let's make it happy.
Yeah, I like that. Or the balloons and ponies.
But not going to pollute in the air. There's nothing. All right, so there's nothing left. We can't do anything. But if we could, flying unicorns. They're just unicorns spreading rainbows. Let's do that. No, but it is. It's actually a really nice way to think about how, for a traditional and traditionally slow-moving industry, how we can still be responsive to what is a pretty rapid pace of change in the broader world. Going back to your earlier point, like insurance is now a board level conversation for a lot of companies or projects because you can't move forward if you can't get coverage. And there is a supply issue, and that's not getting better as CAT activity continues to come in worse than the models predicted. That's really
and it even changes the capital formation within the renewable segment. So if you're maybe like brief example, if you're a single asset, if you own a single asset in Texas and it's a large utility scale asset, it's hard to get insurance for that, right? And I know now being in the space, it's because carriers are managing their exposures and like you only have so much county exposure in Texas for hail exposure. So why do you want to use all that on a single risk? And you'd rather deploy that to get a portfolio.
Yep.
Most asset owners have no idea of any of that, right? Unless their broker's educating them. But it leads to, I wouldn't say this is the primary motivator, but it leads to larger asset owners that are aggregating a good diversity of risk to outperform the market because they're able to get better insurance terms. So it does have maybe not a first order effect, but some sort of second order effect of the way that capital just gets deployed generally within the infrastructure space.
It's really interesting when you think about all of the intertwinedness, if that's a word, of all of this. Like insurance and financing and people starting things up on both sides of the equation, whether it's, a new project or a new M.B.A. or a new solution to the risk transfer problem. I mean, all of it. And that's why like insurance is boring, I think is not true at all, because there is a lot going on within insurance and outside, and we facilitate stuff on the outside. So it's as exciting as you're willing to engage in. Jason, it's great to sit down with you and hear about this. And I should have had you on when I put out my piece on ESG, because it's like spot on, but it's important that we keep the conversation going.
ESG part two.
Yeah, it never ends.
No, I think it's a theme that's going to remain, whether it's ESG or climate. We used to be clean tech, now we're climate tech, as kind of the entire segment that we're part of. So whether it's ESG or climate insurance or something else, but we do think, there's certainly opportunities for innovation, certainly new tools, better data sets, better ways to approach the market. And, we're happy to have the opportunity to be a part of it.
That's awesome. Thank you for sitting down, and best of luck as you build things out. Thank you to Jason for coming on the show and sharing what they're working on at kWh. It's really important. Some of you may have seen the piece I put out in 2021 about ESG, environmental, social, and governmental, and how we are, as an industry, I think really, really responsible for the kinds of changes that the world is trying to make for our own survival. But those of us in insurance, it's not just about that. It's also about what's happening on the climate side and the Nat Cat side. They're all completely intertwined. The work that kWh is doing through their products and what that enables from a change in the energy sector standpoint is a critical component to that. So I will link to that ESG piece in the show notes. Check that out. But please, think about this. And what are we doing as an industry? How are we solving for the kind of needs of a changing energy market and a changing world? And it's through solutions like what kWh Analytics is putting out in the market, through their various, not just their analytics tools, but their insurance products and the carriers that are standing behind them as an M.B.A, providing capacity. That's a really key enabler to what we're trying to change. So check them out. Keep an eye out for them. Maybe if you're in the market to back an M.B.A with capacity and you want to be on, the forward-thinking side of the climate question, maybe that's a partner who you should be thinking about. So I will leave it there. I hope this is interesting to you, and you can check out the ESG piece. And I hope to see you back next time. I'll link to everything in the show notes. Thank you to Pinpoint Predictive for sponsoring this episode. You can learn more about them at pinpoint.ai. Thanks for tuning in.